When it comes to building wealth, there's one principle that has stood the test of time: consistency. Now, I know you're working hard, but what if there was a way to make your money work just as hard for you? That's where these 9 dividend stocks come into play. In this video, I'm going to show you 9 carefully selected dividend stocks that'll pay you every single month, adding a little extra cushion to your wallet and a little extra peace of mind to your life. In the end, I'll show you how you can supercharge your portfolio over the long run and get paid over $3,000 every month. Before we jump into the specifics, let's talk about building a portfolio of high-quality dividend-paying stocks, and that needs to be a diversified one because it helps spread risk across different sectors. It treats your portfolio as a well-balanced meal. You wouldn't eat dessert for every meal, right? You need a variety of foods to stay healthy. Similarly, in investing, spreading your investments across different sectors ensures that your portfolio remains balanced and resilient regardless of market conditions. When selecting the right stocks, I'm not just picking any company that happens to pay a dividend. I'm looking for companies that have a long history of paying dividends, those that have consistently rewarded their shareholders over time. Ideally, these companies have paid dividends for 30 years or more and have shown steady dividend growth for at least a decade. This is because it shows that the company is financially stable and committed to returning value to its shareholders year after year. Even with a portfolio of top-tier companies, there's still the challenge of timing their dividend payouts. Most companies that pay dividends do so on a quarterly basis, meaning they distribute a portion of their profits to shareholders 4 times a year. However, these payments aren't all on the same schedule. Different companies pay out during different months, which, when planned carefully, can create a consistent cash flow throughout the entire year. The genius of this strategy is that it transforms the irregular income stream of quarterly dividends into a reliable monthly paycheck. This means you don't have to worry about timing your expenses around when dividends are paid out because they're arriving regularly just like a salary. This steady income stream makes budgeting easier and gives you the confidence to plan your financial future without fear of market fluctuations disrupting your cash flow. To achieve this, I've divided the year into 3 groups of 4 months each. By selecting stocks that pay dividends in each of these periods, make sure you get a steady stream of payments month after month. Now that we've covered the basics, let's dive into the companies that will help you create this reliable stream of income every month. First up, I have stocks that pay dividends in January, April, July, and October. These are the months when you'll be getting paid in dividends from companies like Philip Morris International, Realty Income, and Altria Group. Philip Morris International is a powerhouse in the tobacco industry, and despite the global shift away from smoking, it's maintained a strong dividend payout. PM's current yield of 4.24% makes it an attractive option for those looking for steady, reliable income. Its diversified product line and consistent dividend history make it a rock-solid option. Realty Income is known as the monthly dividend company. It's been paying dividends every month for decades, making it a favorite among income-focused investors. With a yield of 5.14%, it's a solid addition to any portfolio, especially if you're looking for that regular, reliable income. Realty Income's business model is built around owning and managing commercial real estate, and it passes the rent from its tenants directly to you as a shareholder. Third is the Altria Group, another giant in the tobacco industry, and offers an impressive yield of 7.65%. While tobacco isn't everyone's cup of tea, Altria has diversified its product range to include smokeless tobacco and wine, providing a broad base of income. Its high yield makes it a compelling choice for investors seeking strong returns, especially in the dividend space. Next, we have our February, May, August, and November payment crew. This is where you'll see dividends from companies like AbbVie, Morgan Stanley, and Clorox Company. AbbVie is a pharmaceutical company with a yield of 3.14% that's known for its blockbuster drug Humira, but it's got a whole pipeline of other products too. Healthcare is one of those sectors that's always in demand. People need medicine regardless of what's happening in the economy. That makes AbbVie a solid pick for reliable dividend income. Morgan Stanley is a financial services company with a yield of 3.61%. Now, I know the financial sector can be a bit intimidating, but Morgan Stanley is a powerhouse when it comes to wealth management and investment banking. They've been paying dividends for years, and their strong financial footing means you can count on those payments to keep coming. Clorox Company, with a yield of 3.1%, is, yes, the same company that makes the cleaning products you probably have under your sink right now. But Clorox isn't just about bleach. They own a wide range of brands, from Burt's Bees to Glad. What makes Clorox interesting is its consistency. They've been around for more than a century, and through all that time, they've kept rewarding their shareholders with steady dividends. Finally, we arrive at the March, June, September, and December group. These months will see payouts from United Parcel Service, Sunoco Products Company, and Southern Company. United Parcel Service, or UPS as you probably know, is one of the world's largest delivery companies, boasting a yield of 5.13%. With the explosion of e-commerce, UPS has seen its business and its profits grow significantly. And when UPS does well, so do its shareholders, thanks to those regular dividend payments. Sunoco Products Company might not be a household name, but they are a major player in packaging with a yield of 3.76%. From the boxes that deliver your online shopping to the containers that hold your favorite snacks, Sunoco is behind the scenes making it all happen. Southern Company is a utility company with a yield of 3.36%. Utilities are often considered one of the most stable sectors to invest in because, let's face it, people are always going to need electricity and gas. Southern Company has been paying dividends for decades, making it a dependable source of income for investors. Let's take a look at how these companies stack up in terms of when they pay their dividends and the yields they offer. I'll show you how this portfolio can pay $4,000 in annual dividends, and in the end, I'll show you how you can supercharge this portfolio over the long run and get paid the same amount every month. Now, why is diversification important? Well, even though these companies have been paying dividends consistently for years, nothing in investing is guaranteed. There's always a small chance that one company might cut or suspend its dividend, though that's unlikely given their histories. But still, if it happens, others are there to keep the cash flow steady. It's like having a team where if one player is out, the others step up to keep the game going. All right, now you know how and where to invest for a monthly dividend stream, but you're probably wondering, how much should I invest to make this strategy really work? It's a good question because the amount you invest will directly impact how much income you can generate from these dividends. So what's the ideal amount to invest? For a meaningful and impactful income stream, I suggest investing $10,000 in each of these companies, which with 9 dividend stocks totals $90,000. The idea behind choosing $10,000 per stock is to create a substantial income stream that can truly make a difference in your monthly cash flow. It isn't just about earning a few extra bucks, it's about generating enough income to cover significant expenses, reinvest for compound growth, or simply add a layer of financial security. Now, let's break down how $10,000 in each of these companies translates into actual dollars using the yields we discussed earlier. And to make things simpler, I've broken the year into 3 main periods. The first group includes January, April, July, and October, which we'll call Q1. The second group, or Q2, covers February, May, August, and November. Lastly, the third period, Q3, includes March, June, September, and December. So how do we arrive at these numbers? It's simple. Each stock pays dividends annually, and to figure out how much income you'd get from a $10,000 investment, we multiply the stock's dividend yield percentage by the principal amount. For example, with Philip Morris International, which has a yield of 4.24%, if you invest $10,000, you'll receive $424 annually in dividends. That's the annual payout from Philip Morris, but since most of these companies pay their dividends quarterly, we need to break this amount down further. For each company, you divide the annual income by 4, giving you a clearer picture of what you'll actually be receiving every 3 months. For instance, with Philip Morris, 424 divided by 4 gives you $106 every quarter. The same process applies to the other stocks in the portfolio. For Q1, which includes the months of January, April, July, and October, you'd be getting a total monthly payout of $426 for each of these months. This is your income from Philip Morris, Realty Income, and Altria Group combined. During the months in Q2, February, May, August, and November, you'll collect $246 monthly from stocks like AbbVie, Morgan Stanley, and Clorox. Finally, in Q3, covering the months of March, June, September, and December, you're receiving $306 each month from UPS, Sunoco, and Southern Company. So you've got $426 coming in for some months, $246 in others, and $306 for the rest. This gives you a consistent flow of cash, ensuring you have income coming in every single month regardless of what's happening in the markets. Now, let's zoom out a little and talk about what these numbers mean over time. For the months in Q1, you'll receive a total of $426 multiplied by 4, $1,703. In Q2, that total comes to $985, and for Q3, it's $1,225. Adding all this together, you're looking at an annual income of $3,913. Is this really a big deal? Absolutely! Think about it this way. Your almost $4,000 could cover a couple months' rent or pay for a year's worth of groceries. This income stream is real, tangible money that can make a significant difference in your life, and you're getting it just by holding on to these investments. It's a form of passive income that requires no extra work from you once the initial investments are made. Now remember, in the end, I'll show you how you can supercharge your portfolio over the long run and get paid over $3,000 every month. But first, let's put this into perspective and compare this dividend strategy to other forms of income. For instance, if you were to invest in a savings account or a CD, you'd be lucky to see an interest rate of 2% or 3% in today's market. Even with a high-yield savings account, the returns don't come close to what you're getting here. A $10,000 investment in such an account might earn you $200 or $300 a year in interest. But with these dividend stocks, that same $10,000 can earn you $424 from Philip Morris or $514 from Realty Income, as we've seen. And let's not forget Altria, which could bring in $765 annually. So the trade-off is clear. Dividend stocks offer significantly higher returns than traditional savings vehicles. Sure, they come with some market risk, but for long-term investors, this risk is often outweighed by the rewards, especially when you consider the power of compounding. This brings us to another important point. The beauty of this strategy lies in its flexibility. If you decide to reinvest the dividends instead of spending them, your portfolio grows even faster. Over time, that snowball effect can turn your portfolio into a powerful income-generating machine, one that requires no additional input from you beyond the initial investment. Let's use Altria Group as an example, given its highest yield of 7.65%. If you invest $10,000 in Altria, you'd earn $765 annually. Instead of spending that $765, you could reinvest it to purchase more shares. For simplicity, if Altria's stock price is $40, that $765 would buy you approximately 19 additional shares. Those new shares will then generate dividends of their own in the following year, adding to your income. And here's how it could play out. At the end of year one, your initial investment was $10,000, buying 250 shares. Dividend income was $765, which purchased 19 new shares. At the end of year two, your total shares are 269, the 250 original shares plus the 19 new shares, and your new dividend income increases to $823. Each year, your dividend income grows as you reinvest, increasing the number of shares you own. By year 20, you'll be getting $23,583 in annual dividends from just this one stock. Now, imagine applying this reinvestment strategy across your entire portfolio. Here's how it would break down for our portfolio. The selection of stocks will have a portfolio dividend yield of 4.35%. assuming a conservative dividend growth rate of 5% backed by an average share price appreciation of 5%. Here's what the future prospects of this portfolio look like. If John invests $90,000 with $10,000 in each stock, after 1 year, it'll be valued at $99,315. In 10 years, it'll be valued at $236,840. Fast forward 20 years, and it'll be valued at $601,118. In 30 years, it'll be valued at $1,476,420, paying $43,924 in annual dividends, which equates to roughly a monthly income of $3,660. Want to make this strategy even better? Here's how you can get paid every week.